the point of hedging is that you don't really mind where the price goes, whether it goes up or down. So in the example of the producer, let's say they have a cost of production of $8,000 a ton and they sell a future at $10,000 a ton. As soon as they sell that future, they're locking in that gross margin of $2,000 a ton.
Hello everyone, welcome back to a new podcast episode. Today we are joined by Samuel Basi. Samuel, can you introduce yourself, please?
Yeah, sure, Paul. It's a pleasure to be here today with you. My name's Samuel Basi. I was a commodity trader for 15 years. Started my career at Trafigura and spent 11 years there before moving to a smaller niche trader called Greenwich Metals, where I built their derivatives book from the ground up. At Trafigura, I was on the physical metals trading side. After that, I wrote the book, Perfectly Hedged, A Practical Guide to Base Metals. That was really a practical guide to risk management in the metals space. And since then, we launched the company Perfectly Hedged, which is a consultancy and educational company that works with companies across the supply chain, across the commodities complex, to enhance their risk knowledge, enhance their risk practices, and really get the most out of both their employees and their approach to risk in the commodity space. And most recently, Perfectly Hedged has partnered with the MME itself to run their educational systems, run their educational programs in North America.
Okay, thank you for the introduction. So today will be a masterclass on commodities trading. So we will make a big focus on metal tradings. Metal is quite like we have different type of metal. So maybe you can start explaining the different types of metals, what people should know about this sector when you say metal trading.
Yeah, sure. So metal trading, as you point out, is a fairly wide concept. It's kind of broken down into a few main different elements. You've got your refined metals trading, which is mainly base metals, but your refined metals, which are being processed by your end consumers that are manufacturing those end consumer products. But before that, you have your concentrates metals, which is the mined ore that comes out of the ground, very low percentage metallic content that then goes through a process of concentration. And that then brings that ore up to a metallic content that can then be processed by a smelter, by a refiner, to then turn into that refined metal. A large aspect of metal trading is also the scrap metal trading, especially as we move into the energy transition and people are looking to scrap metal to fill a lot of the holes in supply of refined metals. Scrap metal is becoming an increasingly important part of the metal industry. You also have precious metal trading, which is an entirely different type of trading. So minor metals, that there's not necessarily the liquid exchanges where you can trade futures and hedge that price risk. More of the minor metals or the ferrous metals where there may not be those liquid exchanges. Metals is a really broad, widely encompassing term, but a vast industry that really touches every single part of global trade.
Okay, thank you for this nice insights. So if we want to attach number to what you said, in terms of volume, which one is the biggest metal we trade? So you told us about scrap metals, concentrates. Can you, in terms of volume, which one is the biggest?
So, in terms of volume, you look to metals like iron ore and steel, they're going to be in terms of outright volume of tons traded and consumed and produced, they're going to be the largest metals. But then you look at the exchanges and what, the volumes that people are hedging and trading on futures, it's actually different. So steel, even though it's widely used in millions of tons, it's not as liquid as a product on the exchanges. When you look at the traded metals on the exchanges themselves, copper, aluminium, they're by far more voluminous when it comes to actively being traded on the exchange. So it kind of depends what aspect of volume you're looking at. But certainly the base metals are extremely liquid, extremely widely traded. And then the minor metals, your critical metals, especially at the moment, you're looking at EV materials, your cobalts, your lithiums, in terms of volume, nowhere near as widely traded. However, no less important as we look to kind of the next stages of metals trading.
Okay, very clear. Thank you. So when we talk about metal trading purely, so of course we can trade copper, aluminum. Everyone heard different name. In the biggest trading houses, which one are we trading mostly?
So the most widely traded in terms of the large trading houses themselves will be those base metals, copper, aluminium. They're the most liquid, they're the most hedgeable, and they're the most widely produced and consumed. Now, depending on the size of the trading house, they're going to trade the other base metals, the leads, the zincs, the nickels, the tins. But the more niche the metal becomes, the less hedgeable it becomes, the more of a commodity it becomes, the more specialized you have to be in order to trade that. So the largest trading houses are less likely to trade the ferrometals that can't be hedged on an exchange. But that's not to say that there aren't smaller or medium-sized trading firms that are looking to trade those ferrous products, those minor metals that maybe trade off of a publication rather than on a liquid exchange like the LME or the CME.
Okay, quite clear. Thank you. So now I just want to ask you, Samuel, if I will tell you one by one different type of metal, or maybe you can give a small overview of, for example, where we produce these metals, where we trade them, or what are the particularities or specs of these metals. So, for example, if we start with copper.
Yeah, sure. So, I mean, the largest producers of metal in general, but copper particularly, South America, so Peru, Chile, they're extremely large producers. Obviously, you can't talk about metals without talking about China. They're not only the biggest producer, but also consumer of metals globally. You look at countries, like the US, Canada, Australia, those with those large land masses, those large access, Russia, they're all going to be large producers of not just copper, but metals across the board. And then when you look at the global flows of these metals, they're going to flow to the largest consumption points of those metals. So China, again, it's a large producer. It's also a very large consumer of all of these metals. The US consumes a lot of copper, a lot of aluminium. South America is a net exporter of those metals. That copper they're producing is flowing from South America to the consumption points of those metals. So yeah, metal by metal, we can go through, but the largest overall hubs for consumption, or for production, China, US, Russia, those large kind of land mass, and increasingly Africa as a production point, that's being tapped, by those large traders as Africa becomes more developed.
Okay, on which one do we see growing in terms of metals, and the one that we see decreasing in terms of volume traded, or just?
So I don't really think, outside of potentially lead, where the main consumption of lead is in lead acid batteries, and as we make the shift towards electronic vehicles, EVs, we may start to see a decrease in demand overall for lead. The other base metals, they're all involved in the energy transition. And it's why right now we're seeing oil traders move into the metal trading space to try and capture that increasing demand when you look at metals like aluminium, like copper, like zinc, like nickel, and then also some of the minor metals like lithium, like cobalt, those battery metals. They're all increasing in demand, and that demand looks to be increasing over the next decade, over the coming years, where the increased demand is actually outstripping supply, and we're going to need more mines, more production of all of these metals if we are to achieve that next stage in the energy transition.
Okay. So everything regarding batteries will be, of course, growing metals to trade, I imagine.
Yep. And I mean, for now, that's cobalt, that's lithium, that's nickel, but who knows what the next kind of battery technology will be, and whether that introduces a different substitution, a new metal. But yes, all of those battery metals that are going into EVs are on an upwards kind of demand trajectory.
Okay. What about the precious like metals, for example, gold, silver, platinum?
Yeah, I mean, if you've paid attention to the news, especially last few weeks and months, you've seen silver on a price increase. You've seen gold on a price increase. A lot of that comes back to kind of being used as a hedge against global volatility. But yeah, I mean, people are certainly bullish right now on precious metals, not only from a hedge perspective, but also in their usage when it comes to energy and energy production. You look at solar power, for example, and the utilization of silver in solar. So provided that we stay on the renewable energy course, obviously there's a large amount of macro policy and geopolitical and governmental policy. We've seen a bit of a shift in the last few years in the US, kind of with the new administration moving away from that drive. But I do think that overall, globally, where still remain on that transition. And so I think that the precious metals are going to be equally included in that.
Okay, thank you. And I want to ask you a question regarding ferrous or non-ferrous metals. What is the difference why we call them ferrous?
Yeah, so ferrous basically just means it includes iron. So they're typically iron ore, steel, those ferrous metals. They're not necessarily as liquid on the exchange, although recently there has been a big push, particularly on steel, on exchanges like the CME and the LME, to make that a more liquid, hedgeable, tradable product. Obviously, iron ore trades on the SGX and is very liquid, but that's the main difference. And so base metals have always historically been a lot more liquid in terms of hedging on markets like the LME, the CME, the SHFE, whereas ferrous metals, those iron-containing metals, may be a little bit more difficult to manage outside of iron ore, which is very liquid to trade.
Okay, thank you, Samuel. Now, in terms of need of metals, what are the largest industries on need we do with metals?
So, I mean, it's across the board. I mean, metals goes into everything that we touch. But so from manufacturing, aerospace, auto industry, wiring, manufacturing, building projects. You look to China and 25% of their GDP comes from the construction industry and the housing industry. So anytime new infrastructure comes up, railways, bridges, roads, you're going to need metal as part of that. And so anytime there is new infrastructure bills, anytime there's new manufacturing push, you're going to see a large increase in demand for metals. So that's why anytime there's stimulus from China, anytime there's stimulus from the US, from large governments, it's going to be bullish for metals. It's why anytime manufacturing drops, we do have a bearish view on metals because we're going to demand less of those raw materials. But I mean, in terms of industry, metals is used across the board, extremely widely.
Okay. Very clear. Thank you. Now in terms of how we make steel, the steel like production, how it works, the fuel process, maybe you can guide us step by step, please.
Yeah, sure. So, I mean, from metal, we start in the ground. We mine that ore. So whether that's, whether that's copper, lead, zinc, aluminium, nickel, we start with that mined product, that ore that goes through a process called concentration. And so most ore that's mined is relatively low metallic content. That goes through that process to raise that metallic content. Once you have that concentrates parcel, it's sent to a smelter, a refinery, and then it's turned into a refined metal. So in the form of a cathode, in the form of an ingot, a bar, some kind of solid movable product, whereas concentrates themselves, if you've ever seen a pile of concentrates, it looks like a big pile of sand, a big pile of dirt, that's then processed by a smelter. Once it's in that cathode, that ingot form, it can be used by those end consumers, those manufacturers of those products, be it, cable, wire, rod, sheet. It's processed into another form that can then be used further down the chain to go into, whatever that final consumer good is at the end of the chain.
Okay. When we produce metals, what are I imagine we don't want sulfur, because sulfur can be quite, not in terms of quality, can destroy a little bit the end products, I imagine.
Yeah. So, I mean, look, there's going to be byproducts and different byproducts from every metal that's produced. Obviously, there's been a big push from the environmental side over the last kind of few decades to limit the emissions, to limit what those byproducts are, and especially how we're dealing with them. So you'll get a large byproduct trading come out of the production of metals to deal with that in a safe and environmentally kind of respectable way.
Okay. Very clear. Thank you, Samuel. Now, last question before we start talking trading, to put more geography in the context. So you told us about the biggest producer of metals, but maybe can you explain the different, of course, exporter, importers?
So again, importers, China is the largest, since they've entered into their super cycle. A large portion of the world's metal production flows into China. They're also one of the largest domestic producers. They tend not to export as much metal. They're consuming more than they're producing, even though they are one of the world's biggest producers. So in terms of other producers, you've got those South American countries, particularly for copper. You've got the US, who for copper and aluminium, for example, even though they are producing, they are a net importer as well. So it really is kind of a blend of where the production, but where the manufacturing is globally. Australia, obviously a huge producer of metals and commodities across the board. Russia as well, although the last few years, there's been a lot of constraints on where that Russian production can flow to. We used to get a lot of Russian aluminium coming into the US. That obviously is not happening since the start of that war. So the global flows have changed a little bit, and especially as we've entered what seems to be an time frame of countries that are more leaning towards protectionism and kind of isolation rather than globalization. We have seen a lot of those global flows shift, where, especially when you look at tariffs and things like that, countries are trying to secure a lot more of those what are deemed critical minerals and critical metals moving forwards. And so that has drastically impacted some of those more historical import and export flows.
This episode is sponsored by the Shipping and Commodity Academy. If you want to gain knowledge in the shipping and commodity industry, earn a certification, and boost your career, go visit shippingandcommodityacademy.com, link in the description. So thank you to give us some context in terms of geography. So now let's talk trading, the main goal of the episode. And first of all, I want to ask you, where do we trade metals, the biggest hub for metals trading?
Sure. So, I mean, in terms of where the largest companies sit, they're linked sort of geography to where the metals are consumed, but there are some major hubs just in terms of geography, in terms of offices. So Switzerland is a huge base for metals traders. You've got Trafigura and Glencore, the two largest metal traders in the world, both have their head offices in Switzerland. Singapore is also another huge hub. The US. So US, London used to be, but is less so to an extent now. US, Switzerland, Singapore, China, obviously. And recently we're seeing a big shift into the Middle East, into Dubai, a lot of firms setting up shop in the Middle East. And then you've also got the developing nations, the Indias, those other BRICS nations. And we are seeing a large volume of traders opening up so that they can capitalize on those countries kind of moving into the space as well. But in terms of main kind of office hubs, Switzerland is a huge hub for commodity trading. Singapore, China, US.
Okay, very clear. And most of the trading companies are like big companies like Glencore, Trafigura, or do we see many small trading house trading metals?
So you do get a good mix. One of the reasons why the Trafiguras, the Glencores, those largest companies exist is because the barriers to trading the most liquid, the most widely traded metals are quite high. The financing costs, the infrastructure you need, the logistic capabilities, you do need quite a large and global presence. It's very hard to make a lot of money as a trader purely being a domestic trader. You need that access, that wide global network to really extract as much profit as you need to if you're going to trade metals. But that said, you do get medium-sized traders, smaller niche traders who are able to carve out a profit. Maybe it's not trading, back-to-back copper cathode or aluminium ingots. That's really hard to do unless you're going to trade it at such a volume where you can afford to make a smaller margin. But like the Trafiguras, like the Glencores, you're trading it in such a high volume, it's still worth doing. For the smaller traders, they more need to carve out a niche market, be it a niche metal or a niche kind of part of a larger metal trading, be it a location, be it dealing with smaller companies and smaller volumes that Trafigura, those large traders don't necessarily want to bring into their portfolio. It might be dealing with counterparties who, from a credit risk perspective, might be slightly more risky. And so, while the margin is there, you do have to take a little bit more risk that maybe those larger traders aren't willing to do. So, the market is dominated by a handful of medium and larger traders, but that's not to say that there isn't a place in the market for those smaller traders to try and carve out that niche and offer something to the market that is outside the remit of those larger traders.
Okay. Very clear. Thank you. So now I will ask how we trade metals, but first of all, of course, do we have any benchmark in the metal trading? For example, in crude oil, we have the Brent, we have the Texas. I mean, do we have similar things in metal trading?
Yeah, so you definitely have grades within each of those metals. So, when you're dealing with exchange traded metals, they're all going to be of a certain standard. So if you're picking up metals through the exchange, they're going to be of a set quality. But that doesn't mean that every consumer needs such a high quality. So there's certainly various grades of copper, of aluminium that will fit into different consumers' specifications depending on what final product they're making. And that's certainly a way for the medium and smaller size traders to break into the market and have a hold on a certain grade, or maybe they're going to trade scrap instead of refined metals because it's not something that those larger traders want to do. It might be a lot more time intensive, slightly higher risk profile, like I mentioned. And so certainly trading the different grades of metal themselves is certainly a way you can kind of diversify your different trading portfolios. So yeah, certainly different grades. And then you also trade value add products. So not just kind of discounts to the standard specification, but then also those value added products where you're actually now trading at a premium to the standard products. And again, it's a slightly niche market that those large traders may not have an interest in being involved in. And that then opens up the space for those medium and smaller size traders.
Okay. Can you elaborate a little bit, please, on the grades, different grades we have based on benchmark?
Yeah. So for example, aluminium, your standard kind of exchange traded product is known as P1020. And that's to do with the silicon and the other, the magnesium, the other additives that are part of the aluminium that's produced. You look at zinc, for example, that when you go through the exchange, that specification is called special high grade zinc. It's a 99.995% zinc content material. However, there are consumers that don't need such a high level of, of either aluminium content, zinc content, lead content, copper content. And so you can take those percentages down. You have other elements that make up the balance, and they may trade at a discount to the exchange driven products, and traders will look to take advantage of those different arbitrages and build that network of customers, so they know, okay, if we pick up this grade of material, we have these specific homes it can go to. And, that's part of how they make their money, by linking up a producer who may not have all of those direct links to the different homes with different qualities they produce. The trader will step in, buy all of those different qualities, knowing that they have homes for both the higher grades, the standard grades, and the lower grades of each of those metals.
Okay. And if we compare different grades, like, do we have, what is the one that has most of the time the highest volatility, and the one that is, I would say, more stable? Or it's...
So I wouldn't necessarily say it's a volatility between the grades. It's a different market. And so once you get low enough down on the metallic content where it's viewed as a scrap product, I would say that there's a lot of volatility on the scrap market. there's more, if you're talking about a couple of pips difference on alley content or copper content, you're more just talking about a difference in the premium you're able to charge over and above the exchange price that the commodity settles on.
Okay. So now how we trade metals. So it was the step-by-step process from taking position, what type of position you can take, future, how it works.
Sure. So, I mean, take a step back. The reason traders exist in the first place is to connect the production of metal with the consumption of metal, right? As much as the world has globalized and producers are in direct contact with consumers, the trader is there to connect those two sides of the chain, maybe offering some things that consumers can't. So maybe traders are offering finance or credit terms that otherwise wouldn't be able to be achieved. And they're obviously making their margin in the middle. But, a trade is going to start with a trader contacting a producer, buying that metal. Now, depending on whether they are a concentrates trader or a refined metal trader, they may have the entire chain. So those larger companies are going to source concentrates and they're going to sell that concentrates to a smelter. They then may have a contract with the smelter to buy the refined metal, and then they're going to take that refined metal and sell it to a refined metal consumer. So it depends on the size of the trader and what particular markets they're in. They may be involved direct from the ground all the way through to that final consumption of refined metal, or they may only be involved in the refined metal stage, whereby they're only sourcing their metal from a smelter and then taking it and selling it to a end metal consumer. So in terms of the step by step, it sort of depends on what stage of the metal process a trader is involved in. But to take a refined metal trader, for example, and let's say it's one that does hedge using futures, their first stage is going to be sourcing that refined metal. So let's say they buy a parcel of aluminium from a aluminium producer. When they buy that, they're going to agree the price. So when they do that, that's known as the quotational period, the QP. They're going to agree that QP with the producer, and they're going to take a position on the futures market when they buy that's equal and opposite to that physical purchase. So when they buy a physical, they're going to sell futures on the exchange, and that selling futures is going to protect them against any risk of price volatility in between the time period they're buying that metal physically and selling that metal physically. So let's say they're buying from a producer and they're buying it loaded onto a vessel. So they're buying it free on board, FOB, or maybe they're buying it CIF. So the producer is handling the logistics of the vessel. There's lots of different ways you can structure a trade depending on your experience, depending on how the producer wants to sell to you, or if they're buying from another trader, or depending on if they're buying from a warehouse, or in a warehouse, I should say. But either way, once that metal is being loaded and being delivered to that end consumer, they're going to have another QP with their end consumer that's going to dictate when their physical sale is going to price and how it's going to price. And at that point, when they do fix the price of their end consumption sale, that's when they're going to buy back their futures hedge. And again, they would have protected themselves against price volatility in between the time of their physical purchase and their physical sale.
Okay, very interesting. So if we compare the difference between the trading house and the producer, for example, BHP Rio Tinto can be a producer, and then Trafigura Glencore will buy, like depending how we want to deliver. If we want to take free on board, then we'll buy at a certain price level, and then Trafigura will take care of of the selling to the end user, if I'm correct.
Yeah, and it doesn't have to be that way. There are plenty of producers that are in touch directly and do sell to the end consumer, but traders are there to offer both the producers and the consumers something that they wouldn't be able to get from each other. So whether that's financing terms, credit terms, the logistics, there's a lot of producers that don't want to handle the logistics. That's not their expertise. Their expertise is producing that product, but they want to sell, picked up at their production facility, or they'll deliver to a warehouse locally, and then they want a trader to take it from the warehouse and deal with all of the rest. They want to be paid, as quickly as possible after production, whereas a consumer, as we know, wants to pay as late as possible. So financing is a huge part of the reason that traders exist and can step in the middle. But again, there's also the logistical expertise, and there's just that global network. A producer may only have domestic links to sales, but when you deal with a trader, you're diversifying, you're opening yourself up to essentially open sales without having to actually spend the time and the resources going out and developing those relationships with those end consumption points globally. So a huge part of being a physical trader is developing your relationships across the board so that you have the variety, the diversified homes and sources of metal to keep that flow going.
Okay. So in the case that you control the entire supply chain, so you produce and you trade, so all this correlation is working, because if I'm produce my metals, I don't need to negotiate anything. I don't really need to trade. So
if you're producing metal, you still need to negotiate. There's still pricing terms. There's, when you look at refined metals, there's still the premium that you're selling over and above the exchange price. If you're dealing with concentrates, there's still the TCRC, the treatment charge, which is the discount to the exchange price that concentrate sells at. If you're dealing with scrap metals, you're negotiating the discounts in either outright dollars per ton or percentages. If you're a scrap dealer, you're buying scrap at a certain percentage and then looking to sell it at a higher percentage. So from the production standpoint, there's still a lot of negotiation. Even if you're selling to a trader, it's just that the trader might then handle all of the logistics that you don't want to. You have an end consumer that wants that product delivered to their door, and the producer says, I'd rather leave some margin on the table and allow that trader to step in the middle and deliver that, or I just don't have the access to that end consumption sale, or that trader is offering me something that I'm not going to be able to achieve from that end consumption market. So it's not that there's no negotiation. Traders spend a lot of time negotiating with those producers, not only in terms of the terms of the contract, but the length of the contract. A lot of production goes on multi-year deals that the traders are able to negotiate, and that gives some security to the producers that they have a guaranteed home for that long-term supply. So that's known as an offtake agreement, where a trader will guarantee to buy a set percentage for a certain time frame from the producer. So no, I wouldn't say that there's no negotiation for the producers, and the traders kind of just handle everything. It's just that it often stops at the point of production, and then the trader will be handling the physical logistics on from the producer.
Okay. So yes. So to clarify, even if I have the company who already own all the mines, so I produce my own metals.
Oh, sorry. So you're saying if a company is kind of vertically integrated?
Yeah.
Okay. Yeah. So, again, it depends on how the company is set up. They may have a entirely separate department who's in charge of the mine or in charge of the smelter, and their job is still to generate as much profit as possible. So they're going to still have a commercial contractual arrangement with the trading side of that business unit who's selling to them at market terms. So there will still be a negotiation, but obviously when it's an integrated company who might say, like one of the larger traders who owns a mine, has the smelting operation and also has the trading operation, there's going to be a lot of internal flow of that metal, and it really depends on the structure of that company, whether there's internal negotiation for those contracts or whether it's kind of just viewed as one book that flows from mine all the way through to that end consumption sale.
Okay, very clear. Thank you. And so now, as a trader, so you told us you have the future. So how it really works, this future? I will secure my position and say that the price that will remain this price for in 6 months, for example, or it really works?
Yeah, sure. So on metals, we're really fortunate to have these highly liquid exchanges that in some instances, so if you look, for example, on the LME, on copper and aluminium, if you really wanted to, you can buy or sell a future up to 10 years into the future. Now, most people aren't doing that. The liquidity really suffers the further out you go. Vast majority of trading on the LME, for example, happens within a 3-month prompt date time period. But if you are a mine, for example, and you want to secure a sales price for production that hasn't yet been produced but will be produced over the next 6 months, you can sell a future to the expected date of that physical production. And once you have sold that future, so let's say copper at the moment, you sell a future 4 months from now. So you're looking to sell a January future and you can sell it at around $10,000 per ton. What that means is that wherever the price moves in between September and January, whether it goes up or down, you've locked in that sales price. You've guaranteed a sales price of $10,000 a ton, because when you come to selling that physical supply, when you sell it to your customer, you're going to now buy back that futures position at whatever the price is that you're agreeing with your sales customer. So your kind of margin is built into your cost of production versus that initial sales future price, and that's going to be your margin. You're protected then against that price volatility in case the price drops. If you're a producer or if you're a consumer, you would have bought futures, and you're protected in case the price rises, because when you unwind that futures position, you're going to either make or lose the equivalent of where your physical sale or purchase is. So that's how companies hedge and use futures to, if you're a producer or a consumer, you can lock in a margin versus your fixed cost of production. Or if you're a trader, you're mainly hedging to become price agnostic. You're hedging so that the price volatility, provided you're not a speculative trader, that price volatility, once you've executed that hedge correctly, is not going to negatively impact your profit margins on that trade.
So you should make sure that the market will decrease in terms of price if you decide to sell at $10 a ton. For you as a trader, will be always better if the market, when you sell it, is, for example, at $7 a ton.
So it's actually, the point of hedging is to become price agnostic. So once you've executed a hedge, the point of hedging is that you don't really mind where the price goes, whether it goes up or down. So in the example of the producer, let's say they have a cost of production of $8,000 a ton, and they sell a future at $10,000 a ton. As soon as they sell that future, they're locking in that gross margin of $2,000 a ton. Because let's say they come to January and they're selling that physical product and the price has dropped to $7,000 a ton, even though they're only going to receive from their physical sale that $7,000 a ton, When they buy back their futures position at that same time, they're going to be buying back at that same price of $7,000 a ton. So while they might be losing on their physical, they produced at a cost of $8,000 a ton and are selling at $7,000 a ton. So technically they're losing $1,000 a ton on their physical. They sold futures at $10,000 a ton and are now buying them back at the same price of their physical sale at $7,000 a ton. So they're making $3,000 a ton on their futures position. So as soon as they sell that future, they're locking in that margin. And then whatever way the price moves up or down, their gross margin will still remain that same difference, that $2,000 a ton difference between their cost of production and their futures short position. A trader who wants to remain price agnostic, they're making their margins off of the premiums, off of the treatment charges, those discounts and premiums to the exchange price. So when they buy something, when they buy a physical, they're selling futures at the same price. And then when they sell that physical parcel, they're buying futures back at the same price. So when hedged correctly, those prices will all offset. And what they're left with is their physical margins on the premiums, subtracting logistics costs, finance costs. And that's how traders are able to generate those profits and not be impacted negatively by price fluctuations in between their physical purchases and sales. Now, when you do hedge, you're obviously capping your upside as well. So let's say that producer sells at that $10,000 a ton, and then the prices carry on increasing to $12,000 a ton. Because of that hedge, they're not going to see any of that potential upside over and above their future short position. But a lot of companies would rather lock in a profit margin than risk losing a profit margin through prices that we don't control moving against us. There's obviously, you can look to the options market as well. If you do want to have some runway, and you do get companies that don't hedge because they do want that price exposure. So it really is a company by company decision as to how much you hedge and what method of hedging you choose to utilize. But the overall objective of hedging is to make you price agnostic after the point of executing the hedge.
And how you base your price of the future? Is based on the current spot market and current physical price?
Exactly. So it's less based on the current physical price, but if you're hedging, it implies there's a liquid futures exchange, and that is going to determine the price levels that you're able to buy or sell futures at.
Okay, understand. Okay, interesting. As a trader, you don't imagine you're not always hedging or not always taking future. You as well. Are you trading physical? What are the?
There's certainly traders that trade physical but also take some price risk, and then there's traders that trade physical and don't want any price risk, and so they assume what's known as a perfect hedge. So every single physical parcel they buy or sell, they're taking an equal and opposite.
Okay, sorry,
yeah, they're taking an equal and opposite position in the futures market because they don't want any price risk. But then there are traders who do want to speculate on the prices, and they do believe they can extract additional profits from the movement, from the volatility in the prices. So it really depends on the trader's attitude towards risk, and their infrastructure and what they're able to trade. And that will then influence whether they want to take price risk or whether they want to hedge everything and become completely price agnostic. When it comes to traders that do assume a perfect hedge, that is what they're doing. They're trying to buy at a lower premium or a larger discount, a higher TC, and sell at a higher premium or a lower TC in the concentrates and refined market. Same thing in the scrap metal market. They're trying to buy at a larger discount and sell at a lower discount, which again sounds simple. It's not simple at all. And again, you need to be offering something to the producers, something to the consumers that they can't just get from from each other. So whether that's logistical capabilities, finance, credit, having that relationship, giving that the producer and the consumers that diversification that they are willing to pay for to a trader that allows the trader to make a margin. Now, that's a very kind of high level view. There are also numerous other ways that traders make money, be it through the derivative side, so trading spreads, trading outright, trading options, or be it the nuances in the metals themselves. So whether that's buying at different, different payables, being able to blend material and capture different elements that if a mine produces aren't payable at a time, but then the company can add that to different parcels and find a home that will now pay for certain elements of that parcel. That's all part of being a trader and having that global network and finding the best homes, or whether it's certain companies that can only take certain brands, certain producers of metal that the trader can get hold of and then service that need. So there's outside of that very simple kind of buy low, sell high, there's a lot more to trading than just buying at a low point, selling at a high premium. But that is a large part of the kind of the bread and butter of the physical trader's role.
Okay, so you mentioned quite interesting terms. So trading options, trading spread. Can you maybe explain quickly what is it?
Sure. So I mean, when we hedge, we're taking an outright futures position, the equal and opposite position. The options market is a way that if you want to assume some level of price risk, but you also at the same time want to have that protection. So an option gives you the right, but not the obligation to buy or sell a futures contract. So whereas when you buy a futures contract, you're now obliged to pay that certain price level at that certain settlement date. An option gives you the right, but not the obligation. So if you buy a call, there's two different types of options, a call and a put. If you buy a call, you've got the right, but not the obligation to buy futures at a predetermined strike price, so a predetermined price level, and a predetermined date in the future, which could be days or months, sometimes even years into the future. Same thing on a put. If you buy a put, it gives you the right, but not the obligation to sell a future at a given price at a given date in the future. Now, the reason not everyone uses options, because to get that right, you need to pay a premium to the seller of the option for that option, for that right in the future. So it's more expensive than just hedging using outright futures, but at the same time, it gives you that price runway to potentially increase your profits. So traders that are willing to take some risk and pay for the right, options is certainly something that they look into. There's all kinds of complex options trading strategies as well from a purely speculative point of view. But from a simple hedging point of view, options are a relatively simple way essentially of buying insurance in case the prices move against you. You have the right to still have that futures position, but if they move in your favor, you can take advantage of that price runway. And that's something that producers can use, and it's also something that consumers can use if they want to have some security about future price movements, but they don't want to lock themselves into a specific price. And that is what they do if they were to buy or sell futures.
Okay. Very clear. Thank you. Now I want to ask you another question regarding the physical versus the paper trading.
The actual price levels of the paper trading, is set by all of the information that everyone has at the time. All of those prices going in, the bids, the offers, and that is the screen price that you look at and say, okay, copper or Ali is trading at this level today. The CME and the LME are the two largest two largest futures exchange metals outside of SHFE in China. And the LME and the CME, for certain metals, are backed by physical warrants. So if you take a future position to expiry and leave it open on the LME or the CME, it will become a physical obligation if you're long futures to buy a metal from the exchange warehouse system, or if you're short metal futures to deliver in metal to the exchange system. So the futures market is not divorced from the physical market. Less than 5% of all volume of futures that are traded are taken to expiry and become physical obligations, but it is possible for traders to use their futures positions to either deliver material in as a physical short or receive metal from the exchange system if they let a long futures position expire. But more than 95% of all futures traded in metals are either squared or they're rolled to a further out settlement date, because traders don't want to have those futures positions become physical obligations.
Okay. So I imagine to be a good trader, then depending of course, the profile of the company, if it's a purely trading house, so you are not owning any mines. If you are a good networker, you can reach very interesting clients, producer, mines. It's a big advantage for you. But if you are working for a firm with, of course, who already owns like mines, then you need to be a little bit more analytical. Is that correct? Or again, it's not real?
I mean, I think you look at those larger firms, those Trafiguras, those Glencores, they own mines, they own smelters. They still put just as much effort into developing those relationships with those end consumers, with other miners, with other producers. They're looking to expand that network as wide as possible. Physical trading, the backbone of physical trading is relationships. Building those relationships, spending that face time, developing that trust so that you are the one people go to if they need metal, if they have excess metal. So just because a trader that may own physical assets doesn't mean they're any less driven by those other relationships that they're trying to develop. Every trader is analytical in their approach, but every trader, regardless of asset ownership, has to be equally invested in those relationships across the board, with regards to how they build out their books.
Okay, very clear. Thank you. Now, Samuel, I want to ask you the last questions, more regarding about the work you are doing with your book, with your company, what you provide as a service. Can you explain us, please?
Yeah, sure. So we have the book Perfectly Hedged: A Practical Guide to Base Metals, and that really is an A to Z of practical knowledge on how you go about executing hedges, managing those hedge positions, and how those various different elements of risk are managed by not just trading firms, but producers, consumers, banks, brokers, and just gives you a real insight and gives you that immediately applicable knowledge where you could apply it to your day-to-day job. The larger side of our business is we work across the board with companies themselves, going in, developing training programs, developing risk management systems for those companies so that the ones that don't want to have price risk are fully mitigated against that. But we work with every company on an individual basis. No two companies in this business are the same. So everything is bespoke to their needs. And essentially we help them capture the risk they want to take, the risk they don't want to take, and then implement those strategies, train their staff, and make sure that they're extracting that value from risk management that they should be.
Okay. And so anyway, I will add the link of Perfectly Hedged with your book and of course the website.
Yeah, thank you. So yeah, we have perfectlyhedged.com. It lists all of our services on there. We have our online training, our on-demand training on there as well. So yeah, it'd be great if people check that out.
Samuel, thank you a lot for this episode. You explained us so many concepts, very interesting. So we almost masterclass on physical trading linked to metals. So thank you, Samuel.
That was a pleasure being here with you, Paul.